Hello everyone, welcome to Just Invest Today. Guys, today we have a good video. Today we're going to be talking about Warren Buffett's 1987 shareholder letter and how I kind of connected it. And I wanted to see if everything he's saying in this letter or just this part of the letter is true and if we can relate it back to today, right? So I want to look at what he said in this letter and see if it still applies today. And this is going to provide you with a lot of value to look for strong, competitive, highly successful companies. And that's what we're looking for when we're looking for these long-term compounders. So guys, so this is a 1987 letter. So remember what Warren Buffett says. It's always good to see if it still applies today because things are changing rapidly. So let's get into this video. So first he talks about basically this letter is just talking about his businesses. And when he's talking about his business, he just goes through this little this little ramble right here. So we're going to see what he's saying right here and see if we can identify it and then kind of bring it back till today. There's not a lot of new to report about these businesses, and that's good, not bad. Severe change and exceptional returns usually don't mix. Most investors, of course, behave as if just the opposite were true. That is, they usually confer to the highest price-earnings ratios on exotic-sounding businesses that hold out the promise of feverish change. The prospect-less investors fantasize about future profitability rather than face today's business realities. For such investor dreamers, any blind date is preferable to one with the girl next door, no matter how desirable she may be. And this is very interesting because he just talks about companies that are doing new things are changing rapidly. People always assume that these profits are going to be huge. But what he's really saying is these turnaround companies, these companies that are making new things, they're probably not going to behave, not going to be as profitable as the company that's not doing those things and just staying on its own course. So experience, however, indicates that the best businesses' returns are usually achieved by companies that are doing something quite similar today to what they were doing 5 or 10 years ago. So businesses that are continuing on their success path. That's the businesses that he's talking about. That is no argument for managerial compliancy. Businesses always have opportunities to improve service, product lines, manufacturing techniques, and the like. And obviously these opportunities should be seized. So we still want these businesses to have strong, unique characteristics that makes it strong. And he still wants you to change them, to get the managers to still think about innovation. It's always key. You can't have a company that is be complacent in today's environment when innovation is huge. So he's not saying don't do new things, but make sure you're still on your path of your company. But a business that constantly encounters major change also encounters many chances for major errors. So there's a lot of errors when you change rapidly. Furthermore, economic terrain that is forever shifting violently is ground on which it is difficult to build a fortress like business franchise. Such a franchise is usually key to sustain high returns. So he goes into a fortune study. The fortune study I mentioned earlier supports our view. Only 25 of the 1,000 companies meet 2 tests of economic excellence, on average return on equity of over 20%. So this is what we're going to be looking at. Looking at companies that are getting over 20% returns and look at the strongest companies that performed in the last 30 years. So 20% in the 10 years, 1977 through 1986, and no year worse than 15%. These business superstars were also stock market superstars. So companies that earn high return on equity consistently over 20% were the superstars in this study that he did during his decade. During the decade, 24 out of the 25 outperformed the S&P 500. So we're gonna see if we can find these high equity companies and see if it's still true today. The fortune champs may surprise you in 2 respects. First, most use very little leverage. That's good to know. Compared to their interest-paying capacity, really good businesses usually don't need to borrow. Second, except for one company that is high-tech, several others that manufacture ethical drugs, the companies are in businesses that, on balance, seem rather mundane. Must sell non-sexy products or services in much the same manner as they did 10 years ago, though in larger quantities now or higher prices or both. The record of these 25 companies confirms that making the most of an already strong business franchise or concentrating on a single winning business theme is what usually produces exceptional economics. So the 25 companies, I'm not sure which companies he talks about or he's talking about, but it doesn't matter. Basically, what he's saying is that the companies that performed the best didn't have to use a lot of leverage. They made their own money, they were profitable. And then he kind of excuses high tech, because guys, remember, this is 1987, so tech wasn't really there. So tech and drugs. So that's how we have to kind of change it, because we know tech right now is huge. But he's saying that the most mundane products, the boring products that are just on its straight and narrow path of producing and producing, and that's what the best companies were doing. Maybe a company probably like Clorox that is just making the same product, maybe adding little things here and there, but they're just increasing sales year after year after year. And he's saying these companies were performing the best. So we're gonna see and check some of this out, and maybe you can even do your own research after, but let's get into it right now. So guys, here is the list of the best performing stocks in the S&P 500 over the last 30 years, from 1991 to 2021. So guys, there's been a lot of stuff in this. Remember the tech crash and the 2008 housing market crash. So this is a good sample size of 30 years, right? So here's the best performing stocks. Monster Beverage, 37%. Wow, Amazon, 37%. I'm not using this company, this company right here, because it's health information. We won't know how to pick those companies. So Jack and Henry, this is like a payment processing company, a railroad company, Kansas City Southern, 25%, 25%. Strong Gains, 25%. Best Buy, that's a surprising. I never thought Best Buy. It makes sense, but damn, like, yeah, Best Buy. 20 around 24%. Ross Stores, uh what is it, 24%, and that's what it is. Netflix, Pool Corp, Altria. Okay, so we're gonna check some of these companies and see what they did, and did they earn these high return on equity, as Warren Buffett was saying that those are the companies that produce the best results and kind of those mundane simple products. But let's first start with Monster. That was the first stock. Monster, look at this chart, guys. Huge, from 1991 all the way. Look at that chart. Holy, 235,000%, guys. That was the best performing stock. And does this fit his criteria? High return on equity for very long periods of time, and a kind of boring mundane product in the same product. That fits that criteria. Monster Beverage, exactly what he's talking about. So the best performing stock fit his criteria. High return on equity, ROE, 27%, 26%, 27%, 21%, 21%, 11%, but 31%. But see, that's okay. Like, you're gonna have a dip here and there, whatever. But look, return on investment. Look at that. Like, those are crazy return on equity margins for this company, right? So there you go. That's one company, and then the next company is Amazon. Amazon, see, Amazon doesn't fit this criteria really, because Amazon was a harder pick. It didn't earn its return on equity. It's high now, 22%, 18%, 23%, 10, 12. But back then, it was doing negative, guys. So Amazon is not one, it was not an easy one to pick out, guys, because no one knew it was going to be this big probably when it was first starting out. But it does have that mundane product that he's talking about, that it just sells regular products that like anyone can buy. Like, it started out with books and then clothes and whatever right now, and then simple products. So it kind of meets one of that criteria. And then we can go to Kansas City Southern, and look at this. Look at this stock chart. Perfect stock chart. And this is a railroad company, so you know it's very mundane. It's gonna have that long track record, and that that good growth, like good steady growth, because it's just a railroad, right? And but didn't meet the return on equity criteria. So return on investment, return on equity, 14%, 11, 12, 19, 10, 12. So it didn't really meet the return on equity requirement, but it did meet one of the other criteria of a mundane, kind of boring, not really high flying tech company. So that's another example. And we saw the stock chart, which is crazy. Look at that stock chart, 2,000% since 2008. Whew, crazy. Let's go to Jack and Henry now. Uh, Look at this. So did it meet the return on equity requirement? 90%, 19, 27, 22, 24, 21, 19, 16, 15, 15. I think it meets that requirement to 19, 19, 27, 21, 24, 20, 19, and not a lot of debt. So it meets the criteria of kind of like an easy, simple product, payment processing, right? With high return on equity. So that's another one. So actually, 2 out of the 4 companies have it right now. And then we go to Best Buy. Return on equity, 39, 40, 44, 27, 25, 18, 24. Boom. Meets that requirement. So high return on equity, mundane, kind of boring products that are just going to last forever. Electronics. So there's another one and it has crazy gains for 30 plus years. Top of the chart. Then the last one, we're gonna go to Ross Stores. Return on equity. I don't count this year because we know it's the COVID year. 49%, 48%, 44, 40, 41, 40, 41, 40. So Ross Stores kills it. Ross Stores is killing the return on equity segment of what Warren Buffett was talking about. High return on equity, not a lot of debt, plus has a mundane kind of boring product. It just sells clothes, like thrift stuff, thrift clothes, basically on sale. So I think what Warren Buffett is talking about has some like still has some power. This is from 1987, and I think what he's saying is still gonna be true the next 20, 30 years. I believe that. So if we can find these mundane companies, not a lot of debt, high return on equity, on a high ROIC, return on equity, these are going to be these long-term compounders that we see going into the future. And those are the stocks that we want to own. So guys, tell me what you think about this video. Did you like it? Did you get some like new information from this video? Are you going to put anything of this into practice? Guys, if you like this video, like it, subscribe to my channel. Back to you in the next video. Peace.